Here we're going to talk about some of the tax issues. This is the number 4 planning mistake. Everybody loves to talk about taxes, right? Death and taxes. That's what I get to talk about every day. So I have a lot of people that will move to the Southwest from other states. And those other states that they move from are typically what we call common law or separate property states. In the Southwest, especially in states like California, Nevada, Arizona, New Mexico, Texas, are what we call community property states. There's only 9 community property states in the country. Community property is much more beneficial for estate planning purposes than common law states. And I'll give you an example. If you were living in Minnesota or Illinois or New York or Michigan, and you're married and one of you passes away, you're able to do what's called a step up in basis for 50% of your assets. So whatever the value is, like say of a brokerage account, and you had stocks that grew in value, then you could raise the basis of those stocks for 50% of their value. So for example, let's say that you bought a share of Amazon stock way back when for $10 a share. And then over time, that stock went to $110 a share. You have a $100 long-term capital gain. When you sell that stock, the government says, hey, we get a piece of that. And depending on where you live, that is anywhere between 15% and up. So it's important to understand how that works. If you are in a common law state, at death, you can raise that from $10, half of it you can raise up to the new basis, whatever the value was on the date of death. In a community property state, you get to raise 100% of that. So all of the assets can be raised to whatever the value is on the date of death. And then the second death, potentially you could do it again where you can raise 100% of it to the value so that your kids have very little, if any, capital gains tax, or your beneficiaries on the second death if you're a married couple. So if you had a plan created out of state, not in New Mexico or Arizona, very, very, very important that you get that plan updated. That alone could potentially save tens of thousands. I've seen it save hundreds and hundreds of thousands of dollars in capital gains taxes. All right. Now, I mentioned that the estate tax exemption right now is $11.58 million each. That law sunsets in 2025. So in about 4.5 years, it goes away. And it goes back to what it was before, which was $5 million. So that's a big drop. Well, we also have a presidential election this year. And in no way am I trying to be political, but it's important to understand that that could have a significant impact on your plan. And so you have to be prepared and understand that things can change. And potentially, it could drop well below $5 million, especially considering the amount of spending that the government has done recently for the stimulus plans because of COVID. They're going to be looking for ways to recoup some of that money. And then I would not be surprised at all for the estate tax to be one of those. So I would not be surprised to see that number not drop to 5, but even drop to $3 or $3.5 million. And then that starts to really affect a lot more people, because that includes the value of your home, the value of your retirement accounts, potentially life insurance, all of those things. Okay, so that was just an example. Now, you also have some states that have state estate tax. Now, this is in addition to the federal estate tax. So it's very important. And these are much lower numbers. So please, again, if you have, and we would not be surprised to see California jump into this mix again, because they have some significant financial situations there. But right now they do not have one. But you can see that there's several states that have a state estate tax, in addition to the federal estate tax. So we talked about the Supreme Court case, and Clark v. Raymaker is the name of the case, about, okay, what can we do to handle that? Because right now, most of the time, we don't have the protection. If somebody just has what I call a probate avoidance trust, which is what the vast majority of trusts are out there that are designed to just avoid probate and then go outright distributions, you're not going to have any protection for these retirement accounts. Also understand what's the impact of that retirement account to your beneficiaries now that the Congress has passed this new Secure Act. And I will tell you, the Secure Act caught a lot of people off guard because there was a feeling that this really wouldn't get passed until after the election. But they swooped it in as part of the budget that was passed right before Christmas. And so it became effective at the beginning of the year. And it is a major, major change to how to plan for your retirement account. I would strongly recommend that you talk to your financial advisor and your accountant about potentially Rothing your IRA or starting to look at Roths. And it's just a math question, but it's something to really consider because of the impact of the Secure Act. Some of the ways that we're looking at to try and address that issue are using things called charitable remainder trusts, as I mentioned, Rothing your IRA, and then sometimes looking at a life insurance policy that could offset the cost of the income tax that they're going to lose. Because think about when those required minimum distributions come out to your beneficiaries, and let's just say it's your kids, it's going to be income on top of their income. So it often will bump them to a much higher tax bracket, therefore causing that to be taxed higher. And they'll often will pay 50% roughly when you add in state taxes, 50% of that IRA could be lost. So what can we do and how can we handle that? Well, there are options that we can talk about. Okay, so just important to really go into that. Again, just want to go out there. Does anybody have any questions? Anything you'd like me to talk more about as we go through that? By all means, we've got people here that are monitoring the chat line, the raising your hand. We can let you talk, or you can just type in questions. So feel free, if any of those, as I've talked about things, if any of those bring up questions that you might have. Now, here's the big one. We have cases where one spouse dies, and I'm going to use my wife and I as an example. If I passed away first, and a couple years later, my wife started to get lonely, and all of a sudden the pool boy comes along, and she sees this pool boy, and the pool boy, who's younger than her and has kids of his own, offers some companionship. And obviously I'm teasing, I don't mean to offend pool boys out there. But if she got remarried, the question immediately comes is to, well, what about our kids? My wife and I have 4 children and one incredibly adorable grandchild. What happens to them if all of a sudden there's now new kids in the picture? Because naturally that spouse, meaning my wife, would feel some type of obligation to her new spouse. And I will tell you, you would be shocked at how often what we have created, my wife and I, for our children often end up with the pool boy's kids. I see it far, far, far too often. So it's important to talk about that, plan for it. What can we do to protect it? For example, I can even put in provisions that say if the surviving spouse gets remarried, they have to sign a prenup. And so there's a lot of different things that we can do in an estate plan that can try to address some of these issues. And we don't know of all these issues what you, your spouse, or your your beneficiaries might face. So we try to cover as many as possible. And that's the benefit of being a member of what's called the American Academy of Estate Planning Attorneys. And we are one of the charter members of that organization, but it's an elite estate planning organization across the country. And in Arizona, there are only 3 firms authorized by the Academy. And I believe in New Mexico, I think there's only 1. So, which is us. So, you know, it's a very, very important organization that helps us to make sure our plans are very, very effective.